Hello and welcome. I'm Alex Promos, Head of Institutional Content and Investment Magazine, and this is Market Narratives. This show is a series of unorthodox conversations with thought leaders influencing the world of fiduciary investors. For more related insights and analysis, please remember to check out our website, investmentmagazine.com.au, and subscribe for a free email. And with that, please enjoy this week's episode. My guest today is Ronan McCabe, who's the Head of Portfolio Management at Mercer Investment Management. Welcome, Ronan. How are you?
Fine, Alex. All well. Adjusting now to, I think it's week 9 or week 10 of working from home, but yeah, all gone well.
Fantastic. I thought, one of the places that we can start today is, to sort of talk about, this crisis and how to operate and re-look at your portfolio in this type of environment. But before we get there, I thought it's a good idea for you to maybe give a bit of background in your last couple of roles until you get till today, and then we can give a bit of context in terms of how you think about portfolio management.
Great. Thanks, Alex. So I've been in my current role as Head of Portfolio Management for Mercer's investment management business here in the Pacific for the last 14 months. Prior to that, I spent 4 years with the Irish Sovereign Wealth Fund running their global portfolio, as well as working on certain niche projects on the private side of their portfolios as well. Prior to that, I was on the opposite side of the table, where I worked on portfolio management and portfolio construction for Pioneer Investments, global investment manager, on their fixed income and credit suite of products. And prior to that, my experience was predominantly on distressed debt as well as ABS and CLO investing. So it's interesting, my current role, where I've been on both the pure asset owner side of the table with Sovereign Wealth Fund, as well as being an asset manager for both a global firm as well as boutique asset manager. So it's kind of given me, as well as prior to that, to a bank as well, quite a good broad perspective on the industry overall.
Mm-hmm. So given the sort of the current volatility that we've seen, it seems to have died back a little bit more. I guess this is a good chance for all funds, on and the asset owner side, to sort of review their investment processes. Curious to see, what have you guys been learning over the last few months?
Yeah, so it's quite interesting. I think more in general, there's just that old phrase from I believe it's Warren Buffett, that when the tide goes out, you realize who's wearing their swim trunks and not. I think that applies to both portfolios, but also around processes, such as on the operational and implementation side of things. So during the initial bout of volatility in March, similar to a lot of other funds here in Australia and probably globally, we spent a lot of time just looking into and reassessing on a very, very regular basis, like many times a day, just our liquidity position. As volatility and liquidity kind of subsided somewhat, we started then, kind of checking into our portfolios a bit more depth, what our managers were doing, where risks lay in our portfolios. Through that as well, though, we very much kind of assessed the implementation side of things and the operational side of things, where there were certain risks, what we were doing right, as well as lessons we can maybe learn going forward. So there has been a lot of learnings over the recent past, and given, as you said, it's volatility has subsided somewhat. I think there will be quite an interesting period going ahead. There will be a recession, and there's people are still kind of different thoughts out there, whether it be a V, a W, a U, L-shaped recovery, but there will be some sort of initial recession. So the learnings we've been taking note of, we need to kind of put them into practice going forward as well.
Are you putting any of those, into practice in terms of the SAA, or is that still on hold as you try to sort of get a bit more clarity where the economy is going?
In terms of SAA, so we're doing an ongoing, which was before the crisis anyway, would have been part of an ongoing process every couple of years, just an SAA kind of rethink and review. There will be kind of some tweaks to that on the basis of the current situation. SAA, though, I suppose by their very nature, shouldn't be so short-term. So you shouldn't have dramatic short-term changes in your SAA and your SAA assumptions in short-term. That'll be more fed in through from DAA positionings, as well as any of your active managers. But some SAA consideration will be things like around that, long-term premia should be long-term in their nature, but the starting point of where rates are at the moment, where the evolution of rates will go in cash over the medium to long term will have an impact on your SAA positioning. So it's not necessarily around the SAA, it's more around the day-to-day considerations of risk in our portfolios. So a lot of what we do maybe coming down a level when we look at our single sector asset allocations, such as, say, for example, emerging market equities. What's the objective of what we have that as an asset allocation or as a beta? What we think the underlying managers we have and the roles they play in it, reassessing and rewriting the thesis, re-underwriting the thesis of why we've hired certain managers to perform certain roles. Are they still continuing to play that role? And how do we think those objectives and the role of those managers will evolve over time?
Mm-hmm. Let's dig into those single sector options in terms of, how do you review them? Is there an early indication in terms of how they've performed? Particularly there's always a lot of question about the role of active managers and whether they can deliver. Curious on your thoughts and sort of how these guys in different sectors have been performing.
Yeah, I think it's an interesting one. From what we've seen in our funds and what we've seen more broadly across different asset classes, I think Q1, the recent volatility in the market environment wasn't particularly kind for active management in general. I think, a lot of that is probably more, it was over a 6-week period from mid-February to March, the end of March. So you've probably seen yourself, there's a lot of these charts and graphs gone around showing the severity and what I would say the violence of the market turmoil in that last 6 weeks of the quarter. So a lot of managers were probably positioned for growth over 2020 into 2021 with any recession kind of coming back into 21 into 22. So anything that even with a slight pro-growth, slight risk on, given the nature of the market turmoil, would have been severely impacted. It was interesting, the initial figures we've seen for April, there's been quite a dramatic recovery in active management overall. So I try and kind of, stay away from the short-term nature of what that is and the roles and the performance per se of active managers. But if there's a certain manager, we believe they have a certain role to play in a portfolio and hasn't performed that certain role, notwithstanding caveats of why that may be, that's very much a reason why we will kind of look to kind of revisit that and, very much engaging and talking with the managers that understanding, this is why you've been hired, this is a role of what you should be doing. Such certain market environments happened, your performance was X. What was the reasons for that? Trying to understand maybe learnings from managers as well as what insights they've seen, what they've learned themselves. Again, I think it is important to note that the very nature of the market events in Q1, and let's say the second half Q1, whether you want to consider them as a black swan or extreme left tail event, that no one could envisage the severity, and the word such as unprecedented has been used, and unprecedented at the times. But it was something known, the pandemic of this nature, that you would have 80% of the world's population effectively working from home or remote working. So portfolios in general weren't set up for that. However, going forward, there will be a lot of economic uncertainty. So how are managers positioned for that going forward, and how their organizations, because there will be a lot of kind of change going forward. So it's very much trying to get into the bottom of that.
The question about how to really review active managers is a constant challenge, right? Because they'll say, well, it's too short. You've only looked at us over a certain quarter or a certain month or a certain year or a certain 2 years. But I guess one of the real big problems in terms of trying to evaluate them is, there is a lot of passive flows. There is a lot of systematic trading in the markets. There was also a huge demand on liquidity in markets around that period. And sometimes there can be some very unfair advantages that play into some of these active managers that get, hit just because of the broader impact of the market. So I guess how do you try to distinguish between underperformance versus, it just underperformed because of a broader market impact, reflexivity in markets that's caused them problems.
Yeah, so I think what you're maybe alluding to is how do you differentiate between luck, whether it's good or bad, the actual skill and actually kind of true alpha, as you call it. So an example is, without naming names, it was, a manager we know very well in kind of the credit space, the kind of absolute return, total return credit space. So at one point in time, they would have been down over the course of Q1. I think they were down 20%. And a lot of it was they were holding a lot of high quality securitized assets. Obviously, the bid-ask spread and these assets blew out, and it was actually, you couldn't sell these things if you wanted to. So the mark-to-market impact was quite dramatic. They've had like 10 to 12% recovery since the trough in the mark-to-market of the book. But, they themselves and the quality of the assets they hold, just little to, it's not a non-zero, but there's a very low probability chance that there will be any impairment on those sort of assets. But again, it was a mark-to-market issue. So to a certain degree, there's a level of bad luck with something like that. And by the very, very nature of what they were holding, it's the question is less so around the performance per se, but more around were they kind of taking certain levels of risk, not necessarily mark-to-market and volatility risk, but certain levels of risk meeting their objectives in a particular strategy they're running. On the flip side of that, there's another manager we know in the equity space. They've delivered, as of the end of April, they've delivered 20% alpha versus an MSCI World benchmark over the last 4 months. So while the MSCI World is still down, I think 11 or 12% as of the end of April, this particular manager is up 8.5%, 9% positive, absolute for the last 4 months. And again, there's a certain level of skill and they're a persistent manager, but that level of alpha, quite a sizable portion of it is down to pure luck. So as an example, one of the investments or sort of investments they made were the type of industries that have done fantastically well on the back of this particular crisis. So certain remote access VC companies or anything that kind of would have done positively as a company and a revenue perspective on the back of people working remotely from around the world. But that manager, the reason they've done so well and the reason what particular stocks they've invested in done well might be to do with a thesis that's due to play out over the next 5 to 7 years that has been accelerated quite rapidly over the course of a couple of months, given what's going on globally. So there's still a level of skill and insight that's attributed to that particular alpha. But at the same time, there's a certain level of positive luck. So again, there is so it is difficult to kind of pick active managers. It is difficult. Investment is tough. Pure skill is difficult to find. But there is part of what we try and do is differentiate between what is luck, whether it's good or bad luck, versus what's actually pure skill and insights.
So coming back to the SAA where we started, and as I said, absolutely understand that this is a long-term piece, but it was also a question about the potential impact from COVID. You talk about sort of the changing nature of work for people and the societal change. We've also seen a big decrease in market price, asset prices initially, and then you've seen a very significant recovery in the equity markets in the US. So how do you then rethink, in terms of what's happened there? How do you position yourself, maybe to protect yourself potentially, if the markets run a little bit ahead of where the economic fundamentals are?
Yeah, so it's it's a good question. So obviously, as you've said, the US equity markets in particular have rebounded very, very strongly versus other equity markets globally. So if you think of, from the SCA decision as of the end of March, a lot of people's portfolios would have been maybe out of whack somewhat. There would have been, by the very nature of them, private assets wouldn't move as rapidly in terms of their valuations. So you might have a very large overweight versus your SAA and your private markets, but you also then have a large underweight on your equity markets. And this is something that, happens time and time again whenever there's a crisis of these sort of magnitudes. It's what we saw in 2008 with a lot of pension funds around the world. It's what we would have saw in 2001 as well. And, through time, that balance between private markets and the slow moving valuations or volatility per se of their valuations versus what you see more in the equities and fixed income markets, which are more faster moving. So it is a balance between, at its trough, how do you balance back versus your SAAs, saying your equity holdings. So given the rebound in the US equity markets, again, how you play that is maybe more kind of a DA position in the short term. But it's through the long term, it should be more kind of you sticking with what you think your longer term SAA allocations will be.
Mm-hmm. Yeah, I guess my next sort of question that comes out from the SAA is, as you think about where interest rates are, are you really starting to reconsider the risk premiums that you're pricing across the whole portfolio?
So where interest rates are, does that affect how you think about the long term risk premium across different asset classes?
So particularly around the threat that interest rates could go negative, and then what that may do, and how do you think about the broader ramifications of that? I guess a flip side of lower interest rates is, yes, you get lower nominal rates, but sometimes the real rates of these assets will actually increase. And so how does that then filter back into your portfolio mix?
Yeah, so it's one of those ones. I suppose how I think about it is that long term expected returns and returns on different asset classes can be thought of as an amalgamation of different risk premium. So if you think about your expected return on a credit portfolio, it's a combination of cash plus your term risk premium for your duration risk, and then you add a credit risk premium on top of that. High yield will add an additional risk premium on top of that. Your equity return will be your cash plus some combination of a term premium from interest rates, and then an equity risk premium of equities long term over government bonds, given that equities themselves are long duration assets. And then your small cap equity will be an additional premium on top of that, or emerging market equities might be an emerging market premium on top of that. Through time, they will fluctuate a bit, but through time, through the long term, in terms of, and this will feed into your SEAs, those risk premiums shouldn't really change too much through time, or are they, this is what you think the long term risk premium will evolve. So even where cash and interest rates go, the risk premium themselves shouldn't change too much. So what will happen is that if your blended long term expected return on equities is 5 to 6%, assuming cash at 1%, and cash goes down to 0 and nothing else happens long term to your other risk premium, you'd expect your equity returns to go from 5 to 6% down to maybe 4 to 5%. Mm-hmm. Notwithstanding that, though, and it's something we would have seen in Europe, there is to be aware of additional bias that as rates start going negative or go to that zero bound, and through that zero bound, are there kind of behavioral biases or behavioral consequences on the risk premia that might affect in the short to medium term, a divergence from the long term risk premium. So what I mean by that is that there might be certain investors that can't hold negatively yielding assets. So in particular, from my experience in Europe, we would have seen this. What that means sometimes is a lot of Europe, if we use the context of Europe over the last number of years, that as interest rates went zero and it went negative in Europe and government bonds, there was an addition, the credit risk premium was somewhat kind of compressed even further on certain European assets purely because people needed yield no matter what. What this meant was they were taking maybe a lot more undue risk for a given absolute return figure that wouldn't be warranted if rates were maybe zero or were in positive territory.
It's an incredible time, right, to work out where is capital flow going, and you sort of mentioned the issue of negative rates being a problem, but we're also starting to see a few little blow-ups in the credit space. You saw a situation earlier this week, I think it was, with United trying to get away some bonds and having to offer almost 12%, somewhere around that place, and they couldn't even get it away. So on one hand, you've got risk premiums contracting and people sort of allocating money and just taking any returns. But then on the other side, there seems to be a blow up in terms of the spreads for some of these other assets. How are we supposed to understand this this backdrop?
So credit spreads, you know, IG, but high yield in particular, obviously blew out quite a lot at the trough of the market. They've rallied in quite a bit, and there's probably quite a bit way to go with them. I think in the credit space that, you know, over the last 10 years, globally, corporate balance sheets have expanded quite a lot. You know, at the moment, globally, in particular in the US, in the investment grade credit space, more than 50%, I think it might be 55% of all investment grade or triple B rated names. You've already started seeing some of these, and there will be a natural migration from some of these names from investment grade down to sub-investment grade or high yield. So, ironically, while that will have certain repercussions, because again, there's certain investors out there that may not be able to hold anything that's not investment grade, and there could be, you know, there's different ways of playing that. There might be forced selling as soon as a bond or issuer gets downgraded to high yield. At the same time, in the high yield space, it's quite interesting that double Bs as a percentage of the high yield space is probably at an all-time high, especially in the US. So as you get a migration from the high triple Bs into the double Bs, the quality of both the investment grade space and obviously the high yield space both improves for the same course of action. So what you're ultimately compensated for with credit spread is effectively the expected loss plus some sort of liquidity premium. Expected loss on your credit is a combination of default probabilities as well as recovery rates or loss given defaults. There will be an uptick in defaults, and you're starting to see that. I think people are maybe forecasting high yield defaults could be between 8 and 10%. That's where kind of markets are implying at the moment. But the second side of the coin is around the recovery rates. So historically, recovery rates in high yield have been probably around 40%. That's what they're priced in CDSs. But, you know, a lot of people are expecting that in this default environment, which is expected, recovery rates will be even lower. So that means overall your expected loss will be higher. So your credit spreads should be higher. Again, where credit spreads are at the moment, you know, there's still a bit of fair value or, you know, or a bit of kind of movement in them to go a bit tighter. But it will, so we will, or you should see an increase in default rates. It will be a different sort of default cycle, I think, than we had in 2008. Recovery rates potentially could be lower for a lot of kind of structural reasons. But longer term, you know, credit is probably, as a lot of other asset classes out there, is still quite an attractive space to play if you know what you're doing. And in particular, it's an area for where if you can get really good, high quality active managers, it's an area that can deliver, we believe, a certain amount of alpha going forward.
You mentioned a lot there about the recovery rates and the potential for default. Are you worried about potential risks or blowback from the credit space leading to then problems in the equity markets, you know, in terms of that flow-on effect?
Yeah, it's a great question because, again, there's different, you know, my own view on it, they're all kind of linked up. And, you know, sometimes when we talk about markets and we think about markets, we very much, you know, as an industry, we can kind of get a bit siloed. You know, we talk about equity markets and we talk separately on credit markets, and the rebound in the US and equity markets is probably slightly different from what we're seeing in credit markets in that same region. I think credit spreads, and in particular high yield spreads, are very highly correlated. Just a spread component with equity markets. So when equity markets trough or fall dramatically, you see high yield spreads blow out. It's all to do with the capital structure. So you have your senior debt, subordinator, high yield debt, and then you finally have your equity. So in terms of a capital structure of the generic corporate, it makes sense. So given what's going on in the corporate space and the potential for high defaults, there is a consideration, and there is a potential for a negative feedback loop that could feed into equity markets. So, you know, a lot of the kind of the corporates are, as I said, there's quite a large cohort that are triple B at the moment. A lot of these are kind of big names. in the equity space and kind of well-known blue chip names. So there will be kind of certain considerations around them. If any of them get into severe trouble, they probably won't. But again, it is a consideration around that. The other aspect with some of these companies is that, especially in the high yield space, that some of them, not all of them, are underpinned less by public listed equity, but by private equity. And there's a consideration, what's going on in the private equity space, how that will feed into the credit markets, which then itself could have a second knock-on effect into the public markets in the equity space.
That's a perfect transition to the private space more broadly, particularly in the Australian market. There's a lot of interest about the unlisted markets and the great opportunity that's there within infrastructure, real estate, private equity as a place to get great risk premia, and to sort of dial down the volatility because they're not mark to market. I'm curious on your thoughts, given your background and looking at this private side. What's your take on what's happening in the Australian market? Are people trying to hide some of the underlying risks with some of these assets?
Yeah, so I've spent probably a certain good portion of my career dealing with private assets, directly, in the thick of deals, and some very kind of chunky, large European deals in particular. Some distressed assets as well as kind of what I've done in the public side. So it's an interesting question. I think when we think about multi-sector funds, or say super fund, or any kind of large asset owner that has many different asset classes, I think private markets and private assets in particular, I think they're a fantastic investment. I think there's a lot of, you get the right investments, you build the right portfolio around them. They're quite interesting, but they come with certain risks, and risks that sometimes people kind of underestimate. And some of that would have played out in Australia over the last couple of weeks and months. I think there's been a lot of that said in the press. But when you think about a portfolio like that, there is a natural tension at times, or imbalance between the private side of the portfolio as well as the public or listed side of the portfolio. Where the public listed side of your portfolio is your equities, your fixed income side, and sometimes maybe your hedge fund, if you can get liquidity in that. Where the tension is around liquidity, because sometimes you have a few different reasons. As we touched upon earlier on, with regards to SAA, due to the mark-to-market, daily mark-to-market of your equity and fixed income, and potentially your hedge fund portfolios if you hold hedge funds, they're in quite a market correction. Your allocation to your listed side of your portfolio, or public side of your portfolio, could be well below its SAA, and obviously the private side of your portfolio could be well above its SAA target. So do you rebalance, and how do you do that, given that you can't sell some of your private assets? I think the other thing with private markets sometimes is, when you go into certain private investments, there's obviously uncalled capital. So if you commit $100 million to a certain property or infrastructure or private equity fund, after 2 years you might have drawn down 40 million. You have 60 million uncalled capital, like that effectively can be called at any stage by the underlying manager. This capital obviously is, you can think of it nearly as a liability, but resides somewhere in your overall portfolio. And, people sometimes think it's cash, but it could be in your equity portfolio, it could be in your fixed income portfolio. That capital, if it needs to be called against you at any point in time, is, in normal circumstances, it can come from your listed equities or your listed fixed income, which isn't too much of an issue when markets are liquid. However, though, in situations like we've seen over the recent past, and these are more kind of extreme situations, when you have markets down quite a lot, that capital is called on the private side. Effectively, you are crystallizing losses at the bottom of the market, maybe on your equities or your credit securities, to fund investments on the private side that mightn't be the opportune time to do that. So there is that imbalance. And, in my previous role in Ireland, this is something, by the very nature of the portfolios we're running there, this is something we worried about and thought about on a regular basis. We framed it in a way that the public side or your listed side of your portfolio had effectively so short a liquidity option, the private side of the portfolio, that could be called against at any stage. And the reason we were paranoid about it was obviously in the previous incarnation of the sovereign wealth fund in 2008, we saw this happen in a very real basis. And we also, in a country that went into an IMF bailout in 2010, we were quite sensitive to certain things like this. So it is an ongoing risk. Other sovereign wealth funds and other large asset owners in the US and North America would experience something similar in 08 to 09. With the oil correction in 2015, you would have had certain jurisdictions and countries and certain organizations that had to kind of the same imbalance between the public and private side of your portfolio. So it is a consideration. And it is that natural tension that people may not give as much kind of credence to because it's the focus on maybe other things in the portfolio. And it's a tension that really only comes to the fore when you've had extreme market situations.
In addition to the liquidity issue, what's your take on sort of the underlying risk that sort of sits in it, because they're only marked to market, occasionally or at a quarter. In the case of PE, it's only marked to market usually every 6 months, or if there's a capital raise. How do you then factor that in? So obviously there's a liquidity issue, but how do you factor in? It almost as this downweight. Do you have a proxy for the risk of these sorts of assets?
Yeah, like I think with if you take aside to market side things, if you were to hold a listed security, a listed equity, or a listed property or infrastructure asset versus an unlisted one, and they were very, very similar in nature, and you didn't have to sell your listed security for 10 years, 15 years, all things being equal, they should deliver the same return through time. It may not be the case. And the reason is, the reason is, there's an illiquidity premium attached to it, but, through time, you should expect they should, all things being equal. I think where people kind of, private assets sometimes have, by their nature, a bit more embedded leverage in them than public assets, as well as to probably makes in their nature kind of a bit more complex. So rolling through the leverage and the illiquidity and complexity aspect of it, you should, all things being equal, be experiencing or expecting a higher risk premium. The mark-to-market side of things, that can work in your favor in many ways. I don't think it's the only reason why you should hold private assets. I think if you're holding private assets just because on the front they seem like lower volatility, that's not necessarily kind of the prudent way to approach. It should be about the quality of the assets, and maybe are you getting something different in terms of return or a different exposure. So as an example, in the US over the last years, and this has been a trend kind of, but in the US in particular, there's been a trend over the last 20 years where the number of listed companies has been getting less and less. I think it's maybe dropped by 50% or so on the US stock exchanges. So you're getting a different sort of exposure if you go into private equity, for example, in the US, which may be more geared towards middle market companies or smaller companies, or even maybe touching into venture capital, which would be more kind of growth, very much upcoming companies. So by the delisting trend that's going on, which seems to continue, the exposure you're getting, if you think it to an economy, is less. So private assets might give you something different than you would normally. Another example is private debt. So the stepping back of banks and the trend over the last 5 to 8 years globally means that a lot of companies, generally middle market to smaller enterprises, aren't getting the bank financing. And this has allowed private or alternative lenders to kind of step into that space and lend to some of these companies. So private debt is, if you kind of strip away the credit risk premium and the quality of, as well as the illiquidity and complexity premium, private debt is maybe giving you a different sort of exposure than you would in a purely IG space, or different because banks are stepping back. So it's a different economic exposure to a certain degree. So I think that's the way you should think about it, instead of just investors focusing on the lower mark to market, because the frequency of valuations in private space is a lot less frequent than what you see in the public space.
Well, that's been a fantastic conversation. Thank you very much for your time today, Ronan. Thank you for joining us. All views expressed on this podcast are subject to change and do not necessarily reflect the views of Connexus Financial. This podcast is for educational purposes only and should not be relied upon as investment advice.